Hello friends, how are you all? So I welcome you to our new lesson, which is lesson number 12. This is the first video of lesson number 12, and this lesson is on international economics. Okay, this is going to be a very important and very interesting topic also. This is my personal favorite. I like international economics a lot, and we'll get to learn a lot of new things here basically, and it is also important for the UPSC exam. So let us begin. As is my convention, I always begin by explaining it to you very basic stuff, very basic things. So let us first understand the basics about international economics. International economics is also known as open economy macroeconomics. Okay, basically, so open economy meaning that the economy is open for foreign trade and foreign transactions. Okay, foreign transactions. That's why it is known as open economy. So when we talk about economies, most of the economies, almost all the economies in the world are basically open economies. Okay, you can argue that they are partially open, partially closed, but that is a different thing. But theoretically, open economy means an economy where international transactions are allowed. Okay, they are taking place. So international transactions meaning they can be exports, they can be imports, okay, they can be financial transactions. So they can be transaction having investments. So different kind of things. Closed economy on the other hand is an economy where international dealings are completely absent. So it is a kind of an island nation. It is completely cut off from the rest of the world, and they are self-sufficient. Okay, they are fulfilling all their needs within the countries. They don't need anybody's support. So there is no such country in the world, but theoretically speaking, a closed economy is such where there is no international dealings. Okay, they don't trade, they don't take loans from anybody, they don't give loans to anybody, they don't need anybody's help basically. Okay, so now what are the different types of transactions that can take place in the international market? Okay, when we are talking about transactions, so transactions meaning in Hindi they are known as len den. Okay, so vyavhar hona, len den hona. So basically what transactions can happen in international market? So the transactions can be of goods. Okay, so for example, you are manufacturing textiles in India, you are selling it in USA, so it is a goods. Okay, it can be of services. For example, you are providing telecom services, okay, to other country. You are providing the business process outsourcing, BPO services, okay, IT enabled services, ITES, different kinds of services, software. Okay, so these are the different services, so there can be trade in that. Then there can be transactions of finances or assets also. For example, foreign investors, as we have seen in the previous video, foreign investors, okay, they are investing in Indian markets through the depository receipts. Okay, they are investing in Indian markets through the depository receipts or participatory notes. So that is one thing. Then there is one company, say for example American company Apple company is opening its factory, okay, in India. So it is a kind of foreign investment. They are purchasing land, they are purchasing different things in India. So they are doing investment, they are giving money, and they are having an asset here. Okay, so it is the transaction in assets or finances. Now when it comes to when we look at the transactions in goods and services, that part of the international economics is known as international trade. And when we look at transactions in finances or assets, that is known as international finance. Okay, and all this together they comprise the balance of payments. Okay, I'll explain it to you in detail what is balance of payments. We'll discuss that in this video only. So basically I'm just giving you a very basic idea what all is there in the international economics or open economy macroeconomics. Now let us move further. So the openness of an economy is measured by one simple ratio, and that ratio is known as foreign trade to GDP ratio. So how much is the foreign trade? Okay, when you are comparing it with the GDP, that defines how much open is your economy. So foreign trade is basically the sum of total imports and total exports of your country. Okay, so and you are taking that ratio with respect to GDP. So imports plus exports divided by GDP. This gives you an indication of openness. So a very simple example, for example, your imports plus exports. So say the imports of a country is 50 billion and exports of a country is say 30 billion. So total imports plus exports becomes 80 billion. And say for example your GDP is say $240 billion. So now this ratio becomes 1:3. So 1:3 is your ratio of GDP to foreign trade to GDP. There is another country whose imports is say 20 billion, whose exports is say 10 billion, and its total GDP is 60 billion. So here the ratio becomes 30/60, meaning 1:2. So this ratio is larger than this ratio. It means this economy is more open than this economy. So this is a very simple calculation again of openness of economy. There are other factors also, but this is a very simplistic measure. So a question can come in the exam that what does the foreign trade to GDP ratio indicate? So it indicates the openness of the economy. Okay. So you just keep this in mind. Now when we talk about transactions, okay, transactions means len den. Okay, in Hindi means there is something which you take and something which you give. Okay, so that is always a transaction. So transaction always means two-way flows. Okay, so when it is imports, so in imports what will happen? If India is importing something, means what? Means India is giving money to the foreign country and it is receiving goods or services from the foreign country. So here the input is goods and service and the output is money. Okay, this is the imports. When it comes to exports, it is the other way around. So India is giving goods and service to the foreign country and it is receiving money in return. So here the input is money, output is goods and service. Okay, and when it comes to foreign investors by foreigners in India, okay, by foreigners, so foreigners are investing in India, meaning what? Foreigners are giving money to India. Okay, they are giving money and in return they are getting the assets. For example, they are purchasing land in India, so the assets, the land is transferred to them and they are giving the money to the India, something like that. Or if they purchase the shares, so share is a kind of assets for them, so they are getting the shares and they are giving us the money. So any transaction that takes place, basically there is involvement of money. Okay, money is involved here. So either it is inflow or outflow. Now what is this money? Basically in our local economy, whenever we go to buy something, for example you go to market and you buy a book and the cost of book is say rupees 300 rupees. So you will give them in Indian currency. Okay, you will give 300 rupees to that shopkeeper and he will accept it. But say for example if you are buying something from USA, so the currency of USA is not rupee, it is dollar. So any shopkeeper, any person, any trader who is selling his commodities, his goods from USA to India, he will not accept rupees because rupee is of no use to him in USA. So he wants money in dollars. Okay, he can accept rupee and then he will convert that rupee into dollars. But when he will accept rupee, only when he is assured that his rupee can be converted into dollar at a fixed exchange rate. Okay, at some stable exchange rate. It should not happen that today the price of dollar is say 50 rupees. Today he is selling and today the price of dollar is 50 rupees and tomorrow it becomes 10 rupees. So this kind of fluctuations, if it is there, he will never accept rupees. Okay, because he is not completely certain about the value of rupee, the stability of rupee. So what is the money in the international transactions? The money in the international transaction, this is somewhere there is a problem. So at international level there is no single currency issued by a central authority. So पूरी दुनिया के लिए कोई central authority नहीं है. जैसे हमारे इंडिया में RBI है, just like we have RBI in our country, there is a Federal Reserve in USA. Every country has a monetary authority, okay, has a central bank. So they are the central authority which gives assurance of the currency. But for the world at the international level, there is no such authority which has a global currency, that there is a single global currency. There is no such thing like that. So when foreign economic agents will accept rupees only if they are convinced that rupee will maintain a stable purchasing power. Stable purchasing power meaning that if suppose $1 today is 50 rupees, so tomorrow $1 should be somewhere around 50. Okay, it should not fluctuate a lot. It can be 49, it can be 48, it can be 51, something like that. So it has to be little bit stable. It should not fluctuate a lot. It should have a stable purchasing power. Like if 50 rupees today, it can buy one pen. So tomorrow also this 50 rupees should be able to buy one pen. It should not happen that one pen will cost 100 rupees tomorrow. Okay, so it means that the rupee does not have a stable purchasing power here if this happens. Okay, that is a condition of hyperinflation, too much of inflation. So governments, what they try across the world, they try to gain confidence by announcing that their national currency will be freely convertible at a fixed rate into another asset, for example gold or other currencies. Okay, so our Indian government has also promised that rupee can be converted into another asset or another currency at a fixed rate. So there is some value to the rupee, there is some purchasing power that that rupee is providing. So that is a function of the national governments. Now all these transactions which take place in the international market, they are recorded in one statement, and that statement is known as balance of payments. Okay, this is a very, very important topic for our exam. So balance of payment, what is the definition of balance of payment? It is a systematic record. Okay, it is a systematic record of what? Of transactions between the residents and non-residents of the country in a given year. So it is a transaction between residents and non-residents, and it is not the transaction between citizens and non-citizens. You have to understand the difference between a resident and a citizen. See, an American person, he's an American citizen, he's having the American passport, but he is residing in India for last 2 years. So he becomes an Indian resident. Okay, he is the Indian resident. If there is an Indian person who has gone outside India, say in USA, and is staying in USA for last 5 years, he is a non-resident. Okay, he is not a resident of India, he is a non-resident Indian, NRI. So basically the transaction between residents and non-residents. So resident can be American citizen also, non-resident can be Indian citizen also. Okay, so for example, if somebody is Indian but he is a resident of USA, and if he is purchasing something from the resident of India, then it will become the exports for India. Okay, it will become a transaction between resident and non-resident. And you know how to define a resident? There are, it is defined in the Income Tax Act. Okay, Income Tax Act defines who is a resident. Usually the normal definition is that a resident is a person who has stayed for a continuous of 182 days in our country. Okay, who has stayed for 182 days in our country is a resident. Okay, so that is, so basically balance of payment is a systematic record of transaction between residents and non-residents. Please keep this in mind, and not between citizens and non-citizens. Okay, so it is not a transaction between, say, Indian and American or Indian and Pakistani. No, it is not like that. It is a transaction between Indian resident and Indian non-residents. Okay, non-residents who are not in India. They can be foreigners, they can be Indians also. Here also they can be foreigners, they can be Indians, something like that. Now the balance of payment, as I have told you, it is a record, it is a systematic record. So because it is a systematic record, it is divided into two heads, basically two accounts. So the first account is the current account, okay, and the second account is the capital account. Okay, so there are two basically accounts here, current account and capital account. Now current account, record the current transactions. Okay, current transactions. This we have seen in the fiscal policy also. What is the meaning of current transactions? Current transactions meaning they are the transaction which do not create any future asset or liability. Okay, asset or liability. They are known as current transaction. मतलब future में कुछ लेना देना इससे related नहीं होगा. They will not create any future asset or liability. So that is known as current transactions. Whereas capital account is an account which records the capital transactions, meaning they are creating some future asset or liability. Okay, future asset or liability. So this is the basic difference. Now what all comes under the current account? So it covers the trade in goods. Okay, whatever trade we are doing in goods, then trade in services. Okay, trade in goods is also known as visible trade, because goods are the tangible things. Okay, you can see it with eyes. Whenever the goods are shipped out of the country in a ship, they can be visible कि अच्छा इतना माल इंडिया से जा रहा है, so much merchandise is going out in a ship. So that's why they are known as visible trade. Services are invisible because they are not seen to be crossing borders with our eyes. Okay, we don't see them getting shipped in airplanes or ships. So basically that's why they are known as invisible trade. And then the third thing is transfer payments. Transfer payments meaning whatever remittances we get. So for example, if somebody is working in USA and he is sending money to his mother or his father, so that becomes a transfer payment. Okay, it can be personal transfer payments, it can be the countrywide transfer payments also. For example, somebody is giving the aid. For example, America is giving aid to India to fight some cyclonic situation. Okay, there is a cyclone and a lot of disaster has come, and America is providing some aid, so it is a transfer payment. Okay, aids are the transfer payments. In capital account, what all will come? In capital account, capital flows will come, basically. Okay, transactions in assets, basically everything, your stocks, bonds, everything, your land, investment in factories, investment in production, everything. So whatever the capital flows, they are accounted here in capital account. They basically, it is a transaction in assets. And the second one is NRI deposits. Okay, so some NRI people who are living in America or Singapore or Australia, UK, Europe, anywhere in the world, so they are depositing their money in the Indian banks, for example. So for example, they are having an NRI account in SBI bank, and they are saving their money in SBI account. So that is known as NRI deposits. See, you understand the difference between remittances and deposits. Remittances are the money which people send it to their relatives, to their parents, to their sister, to their brother. So they are not creating any asset or liability for the country. But NRI deposits are deposited with the banks, with the Indian financial system, and it is a kind of liability. Because it is a deposit, it is a liability for a bank. Any deposit is a liability for the bank. The bank has to return it back, right? It has to pay interest on it. So that's why it comes under the capital account. Okay. In transaction in services also, here there are basically two types of transaction in services. One is the factor payments. Okay, another one is known as non-factor payments. Now factor payments meaning what? See, factor payments meaning, for example, if somebody has invested, some entrepreneur has come and he has invested his money in our country, and he is providing some service. For example, he is providing, say, telecommunication service. Okay, he is providing the telecommunication service. So he has invested in land, he has invested in entrepreneurship, he has invested in capital. So whatever income he will get, whatever rent he will receive from his land or from his entrepreneurship as profit, or as a return to his capital, that will be known as factor payments. Okay, that will be known as factor payments. And non-factor payments meaning any service exports, for example, business process outsourcing, or telecommunication service, or insurance service, or transportation service, or any service which are basically hospitality service. So any service, any transaction in that, it comes under the non-factor payments. Okay, so I think you have broadly understood what comes under capital account and current account. Okay, so now in order to explain to you how balance of payment is calculated, how it is done, I have given you some example here. Okay, now say for example trade in goods. Let us look at this now individually. Okay, now let us look at this individually. So trade in goods, say for example our exports for a given year was 20 billion, X is equal to 20 billion, and imports was 30 billion. Okay, so what is the net trade in goods? Export minus import, it becomes minus 10 billion, right? Because 20 minus 30 will be minus 10. Okay, so now here we are having a trade deficit because it is negative. So whenever this trade balance is negative, it is known as trade deficit. Here in our example it is negative, and if it is positive, it will be called as trade surplus or trade balance. Okay, so here the trade balance is negative, it is minus 10 billion. Now let us come to trade in services. In trade in services also, let us look at the factor payment. For example, the exports is 4 billion. Okay, the people who are coming to the Indian people, the Indian residents who are providing factor services outside, if they are earning something, so it will come into exports. It is service exports. So they are earning 4 billion. And similarly, the outsiders, the non-residents of India, if they are coming and they are doing some imports here, and it is 2 billion. So we are having a net factor payment of positive 2 billion in our country, because our exports is 4 and import is 2. So 4 minus 2 is 2. Now non-factor payment also, say for example exports is 10 billion and import is 2 billion. So here the net inflow, the net income from services is 8 billion. Okay, the net exports is 8 billion. Now transfer payments. Transfer payment meaning again aids, remittances. Say for example inflow in a given year is $5 billion and outflow is $1 billion. Okay, there will be some people who will some foreigners also living here, they will pay, they will send money back to their own country, so that comes under outflow. Or India is giving some aid to foreign country, for example Sri Lanka or Bangladesh or America, any country, so that also comes in outflow. So now the net flow is 4 billion, positive 4 billion, that is a net flow, right? Now what usually happens is this trade in services and transfer payments, these two are combined together. Okay, these two are combined together, and we look at a combined surplus or deficit in this. So here we saw that in trade in services, in factor payment there was a positive 2 billion, in non-factor payment it was positive 8 billion. So total invisible trade was 10 billion surplus, right? 2 plus 8, 10 billion surplus. Now transfer payment was another 4 billion. So when we combine these two, we get a plus 14 billion. Okay, plus 10 billion plus 4 billion. So plus 14 billion is a surplus. Okay, it is a surplus in this current account, in these two heads combined. Now we already know that there was a trade deficit. Okay, so trade surplus or trade deficit is only the balance in trades in goods. You have to remember this. A question can come, what is the meaning of trade surplus or trade deficit? So it is that trade deficit or trade surplus only when it is transaction in goods and not services. See, services are separate. Okay, just keep this in mind. So trade balance or trade deficit is the transaction which it looks in the transaction only in goods. Okay, visible goods. So here minus 10 billion was a trade deficit, 14 billion is a surplus in service and transfer payment. When we combine this together, we get a number. Okay, minus 10 billion plus 14 billion, we get a 4 billion. So this 4 billion is basically your current account surplus. Okay, because all this comes under current account. So this comes under current account surplus because it is positive. If it was negative, it would be called current account deficit. Current account ka ho gaya. Now let us come to capital account. Now in capital account, for example, if the capital flows, if the inflow is say 4 billion, okay, some people are outsider people are investing in India and the total inflow of capital in our country is 4 billion and outflow is 1 billion. Okay, so the net inflow is 4 billion inflow minus 1 billion outflow, 3 billion. Okay, so net inflow is 3 billion. Similarly, say NRI deposits in our country is 0.5 billion. Okay, so this total combined, the total surplus is plus 3.5 billion. Correct? This 3 billion inflow and this 0.5 billion inflow. So the total inflow here in the capital account is plus 3 billion. So this is known as capital account surplus. If it is positive, it is called as surplus. If it is negative, it is called as deficit. This is the capital account surplus. Now we combine both capital account surplus, okay, capital account and current account. So we saw that here we had a current account surplus. We also had a capital account surplus. So basically total combined, here the surplus was 4 billion. Here the surplus is 3.5 billion. Okay, so the total balance of payment, when we combine current account and capital account, we get the total balance of payment. So total balance of payment in our case is 4 billion plus 3.5 billion, 7.5 billion. So now our balance of payment is in surplus because this number is positive. If this number was negative, it would be called balance of payment deficit. Okay, BOP deficit. But here in our example, it is surplus. Now see, all these transactions, okay, above this, everything, this trade in goods, services, transfer payments, capital flows, all these transactions are known as autonomous transactions. Okay, they are known as autonomous transactions because these transactions are done independently of balance of payment, surplus or deficit. So we don't look at this number balance of payment whether it is plus or minus. These things happen and after that we calculate and we get this balance of payment. So they are independent. So that's why they are known as autonomous transactions. There are some accommodating transactions also. So now what happens, just in order to make this BOP zero, actually BOP balance, now what will happen, see here this 7.5 billion is plus. What this indicates? It indicates that $7.5 billion is a in net inflow in our country. इतना foreign capital हमारे इंडिया में net आ रहा है. This is a net foreign capital that is coming into our country. Now this has to be accommodated somewhere. Now what happens? This 7.5 billion gets added to the official forex reserves of Reserve Bank. So we also look at the transactions of official reserve. Okay, official reserve transactions that RBI is doing. So RBI के पास में forex होता है, right? RBI has the forex. So this 7.5 billion will be added to the official reserves of RBI. And now RBI reserves are increased by 7.5 billion. So whenever these reserves are added, the convention is that it is considered to be negative in balance of payment. Okay, it is given a negative sign because now it is considered that this money is taken out of the economy by RBI. Okay, RBI की forex kitty में जा रहा है. It is going in the RBI's forex kitty. Okay, it is going in the RBI's forex kitty. So it is being taken out of the economy by RBI, and that's why it is given a negative sign. Now this 7.5 billion will always be equal to this balance of payment surplus, but with a negative sign. So whatever, if for example, if this was 4.5 billion surplus, here the forex added would be 4.5, right? It would be 4.5. So it is just to balance. It is just a balancing number. Basically, whatever surplus is there, it gets added to the official reserves of RBI. And then there are some omissions and errors also while calculating. Say for example, $1-2 का, $5 का, $10 का कहीं plus minus होता है. So we don't consider the decimal figures. So when we add all those decimal figures, it gives you some error. So that is known as errors and omissions. So that is also included here. And then sometimes sometimes what happens, if this number is in deficit, okay, this number is in deficit. Say for example, balance of payment is minus 10 billion. Now when it is minus 10 billion, what happens? It means that the RBI's reserve will be removed. So RBI will have to pay this $10 billion. Its forex reserves will be reduced by $10 billion. If RBI does not have that $10 billion, okay, RBI does not have sufficient reserves to balance this BOP deficit, such a condition is known as balance of payment crisis. Okay, whenever the RBI or the monetary authority does not have sufficient forex to balance the deficit in balance of payment, net deficit in balance of payment, the situation is known as balance of payment crisis. We will see this kind of situation happened in India in 1991. Okay, we will study about it later on. So in that case, what happens? We are forced to take loans from IMF. Okay, we are forced to take loans of IMF, and in that case, IMF will give us a loan of $10 billion. Okay, so again, now it is an inflow. Loan means inflow, so it is a plus sign. So this plus 10 minus 10, it again becomes 0. So balance of payment in that way always is maintained 0. So balance of payment is always balanced. If it is plus, balance of payment surplus, it is added to the official reserve transaction. Added means it is negative. If it is deficit, that means here it is negative. If it is negative, that means RBI is giving that money in the market, so it is positive. So that is how it is balanced. In case RBI does not have money to balance it, we take the IMF loans. IMF will support. So again, that way the loan will be of the same amount, equal amount. So again, that is how the balance of payment is balanced. So I hope you have understood the balance of payment. It is very crystal clear here. Each and every component you must have understood. If you have any doubt, please ask me in the comment section. Thank you.